Hi, Mr. Mark Selby. How are you, sir?
Good, Mr. Matthew Gordon. How are you?
I'm very well indeed. Looking forward to my holiday. I'm off next Thursday, and no one's going to be able to reach me. You'll think I'm going deep undercover in the jungle.
Those are the best kind of holidays, and you're obviously trying to find who is out there manipulating the gold price and why it hasn't gone to $5,000 an ounce with a war in Ukraine and inflation at 8%.
It's incredible, isn't it? I can't read that market at all. I've got a session this afternoon with some gold producers, and they're going to tell me why gold's still a thing. I'm starting to have doubts. I jest.
In my entire commodity analysis career, I will forecast any material except gold and silver. The reality is gold is the world's oldest Ponzi scheme. At the end of the day, if both marginal supply and marginal demand come from a consumer, that's called a Ponzi scheme. So
I'm glad you said that and not me. I've had enough threats for this year. I need a rest. So the gold is a Ponzi scheme. There, you heard it here first, folks. Right. Well, let's talk about things that do have some utility to them. Nickel. We're going to talk about that today with you and go over quite a few company announcements too. So nickel price, if it's so special, what's it doing?
Yeah. Oh no, it is. Since we last talked, we were poking, over $28,000 a ton 3 or 4 weeks ago. We traded back down several $1,000s a ton, and we've moved back up to those levels. So this morning we're up over $28,000 a ton. In that time frame, we've also seen a little bit of inventory finally show up at the LME. So it's ticked up about 3,000 tons. Wouldn't be surprised to see another 3,000 to 5,000 tons of nickel show up again. Nickel is a 3 million ton market. Again, most analysts right now have anywhere from 80 to 150,000 tons of surplus, and yet this inventory is yet to materialize. Again, I think you'll see as we go into 2023 and the inventory actually isn't anywhere, you'll see people revise that down, and I wouldn't be surprised to see something that's closer to 30 to 50,000 tons for 2022. Again, I think what they're missing is when you have a whole new demand use emerging and people are building new plants for the first time, you forget that you've got to fill up a supply chain that feeds that plant. That plant has a bunch of material inside the plant that's not produced but just recirculates, and then there's a downstream supply chain that also has to get filled up. And so I wouldn't be surprised to see a bunch of that material end up there. And again, it's gone. It's not available to the market. And so again, that's one of the things that analysts tend to get very, 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 very wrong.
So what's happening with China and all of this? We haven't spoken about China for a while, and we've had a lot of fun and games in the market this year. Obviously, clearly, COVID clampdowns coming off. The expectation is that things will improve, people will be able to work, move around, etc., and the demand will rise. And there's the kind of there's the new year factor to all of this. So, what's the expectation as to how China will behave this year, or 2023, I should say?
Yeah, I mean, since the October week holiday, we've seen some back and forth. So I think there was some optimism around COVID restrictions being lifted. People, we came out of there, on a big bump. COVID lockdowns happened again. That took a little bit of steam out of the market. But the key thing for me, back, and we're going to be coming up to the January forecast for the coming year in a month or so, is, my view for nickel this year was always around, we were going to have a choppy first half, but by the end of the year, the huge growth in the EV market was going to really overwhelm everything, and we were going to see nickel prices, really start to move higher. And again, we were in a very tight range for quite a while, and as I said, we're up over $28,000 a ton, which is, more than a decade high. Obviously, it's not reflected in any of the equities that produce that particular metal, but the fundamentals have reasserted themselves. I think in this specific move, typically what happens is sometimes China moves and the LME doesn't. Sometimes the LME moves and China doesn't follow suit. Sometimes both go. This is one of those instances where, I think things are still a little bit tighter in the rest of the world than they are in China. So we've seen the move come first in the rest of the world, and then it'll be interesting to see whether the discounts start to squeeze back up again, and the prices of sulfate, nickel pig iron, stainless, and so forth start to creep up higher again, which is what happens. And again, going into Chinese New Year, that is always a good sign for the coming year. If you see a sharp sell-off in advance of Chinese New Year, that's people thinking, oh, I'm nervous about my order books, so I'm going to lighten up inventory-wise going into Chinese New Year. If the market's strong, and I'm a little nervous about how much inventory I have, because when I get back from Chinese New Year, I might have more business than I'm expecting. Then you'll sometimes see people stocking up. So, in that few week period prior to Chinese New Year, I think that's going to be, will be pretty interesting. And if you go back, when we started to come off the bottom with nickel a few years ago, it was around Chinese New Year where things got exciting, because in the EV sector, it was clear, they had made plans in the fall in terms of what their growth would come from. They got their final, demand from the automakers at the end of the year, and went, oh shit, we may need a lot more nickel. And that really got things rolling at that point. So, I think again, that pre-Chinese New Year period is going to give us a pretty good sign of what's going to happen for the rest of 2023, which I expect to be pretty bullish.
Right, and I tell you, it's just a little story which happened, I think, last week. It was one of the big Canadian funds. I can't remember if it was Teachers, or it was certainly one of the larger ones. Pulled out, sold off 50% of their Tesla stock, and they sold down a lot of the Chinese EV manufacturers too. I think that's company related rather than market related on battery metals. I don't know if you saw that story, did you?
No, I didn't. But again, not surprised. I mean, when you think about it, you had a few pioneers in the EV space who had effectively this, BYD in China, a couple others, and then Tesla, in the rest of the world. Now the herd is coming, right? Ford, I think Ford is now the number 2 seller of EVs in North America, behind Tesla, and they're ramping up a whole slew of new models in 2023. Again, the rest of the North American and European automakers are now charging into the space. I can tell you, the memo of car makers need raw materials has been passed around the auto industry, because again, we had talked to several players earlier, a couple of whom really got it, most of whom were out, to be honest, out to lunch in terms of what the what the raw material supply situation was. They have now figured out that they're screwed for raw materials in the long term, and whether it's the car maker, the battery maker, or the precursor, whoever gets the raw material supply wins. And some of these conversations lead off with, and we're, we want offtake, and we'll provide capital, to help get that offtake. So it's interesting, and literally there's of the major North American and European car makers that we had not had conversations with, we've now had conversations with all of them in the last 3 weeks. So
I think most companies that come on our show are very keen, certainly the battery metal space, are very keen to talk about industry moving into mining, in terms of the moving upstream, as you call it, and trying to take positions in their companies. Now, some have. We've talked about those in the past. Some haven't, and it's going to be part of their sales message that perhaps this will happen. I kind of like that conversation, because it introduces a new source of money for development companies. Development companies, which have been, I guess, slightly, one arm tied behind the back, in the sense that there's a handful of financiers or financing solutions for them. See, there's new money coming in will be interesting, and I'm wondering how that will evolve over the next 2 to 3 years. I mean, as short as that, as the supply chain issues, as you say, everyone's got the memo. It's now a case of, right, we need to nail this down. And there will be a few stumbles, I suspect, because I don't know what conversations you've had, but in terms of what they want, I've been intrigued to understand, if you're able to share that with, what do they need to see from the company to ensure that they're not investing something which is going to fall on its face real quick and going to be an embarrassment to them? As big as their balance sheets are, no one wants to waste their time either, right?
Yeah. Yeah. No, I mean, so the things that are important to them in terms of jurisdiction and location, right? They don't want to invest in a mine where the community, is protesting against it and is going to end up dragging their name through the mud, by association. That's number one. Number two is in terms of the project and team, do they have the experience, to actually do it? Having a couple of geologists run a company, no offense to geologists, but, if you don't have a bunch of mine builders on your team, then that's not going to be as credible to them. And the third piece is just understanding that, okay, you whatever you're producing in your mine, is there a path into their battery precursor partners in terms of that raw material? Because again, they don't necessarily always like metallurgical risk. It's trust me, isn't it doesn't necessarily cut it with auto supply chain executives.
Yeah, it'll be fine. Yeah. Yeah, interesting. Okay, well, look, and then one last thing with regards to, I mean, there's a lot of new people come into the space and try and understand the language and the vocabulary, but so is industry, and so are financiers, because we've introduced this new concept of MAT into the mix. Do you think that is being better understood? Do you think that what Philippines, Indonesia, and China are trying to do is better understood, and is that going to help with forecasting in 2023?
I would say, I think the sort of understanding of MAT, again, people still are really focused on this class 1, class 2 dichotomy, which again is temporary, short term. The MAT in another year, the class 1, class 2 will cease to be a major differentiator. It's going to be high carbon Chinese versus not. And the biggest issue still is out there, and I think this is reflected in, if you look at the nickel, cobalt, and to some extent, graphite story is fundamentally most of the analyst community is not using forecast numbers that are anywhere close to the kind of growth we've already seen in the EV space, and what is embedded as underlying demand over the next 3 to 5 years in terms of EV demand growth. And so, a lot of them, it's like, oh, there's surpluses for the next 3 or 4 years. And then, the shortages really happen in the later part of this decade. Whereas if you use the real kind of, again, it's the analysts never want to be wrong. So they can't put 50, 80, 100% growth forecast for a sector in their forecasts. If you put that in, where things get pretty tight, again, starting this year, with this coming year, and which again was why I've always thought 24, 25 is the most likely time period for the super cycle peaks to emerge. And as I said, we're talking beforehand, is this is exactly what I saw when I was at Inco with China in 2002. Chinese demand grew at 30% a year for the first 3 years of the 2000s, and most analysts maybe had 8% growth at the top end, and then had it going back down again. And it was the same story. It was nickel was going to be in surplus for the next 3 to 4 years. We at Inco said, look, we're going to run out of nickel by 2005-06. And if you use a growth forecast that comes anywhere close to what China is going to grow at, and which has happened, and again, this is the same thing is happening in the EV market. So, and I think that's going to unfold in the next few years, in the next few years here, and particularly at the start of next year.
Yeah. Okay. And obviously the big news out of that region, Indonesia, is the sex ban. What's that going to do for GDP and production?
The what? Sorry, the
sex ban in Indonesia. You haven't read this? It's a great story.
No, I have not seen that. Oh,
yeah,
no.
Yeah. So that's going through the rounds in Parliament over there. So
wow.
None of this unmarried stuff.
Okay.
So another fantastic and fine intervention from religion into politics, which is bad enough on its own. We should probably have a proper session on Indonesia, Philippines, and China in the new year, and see how things are evolving over there as China kind of frees itself up again. But look, company information.
Yeah,
we've got a few companies to go through, so go for it.
Yeah, so what we're seeing now is basically, 18 months ago, people started to get interested in nickel. They got the properties, they got their first exploration season in last year, and we're starting to see the results from sort of the North American, part of the market. So, with Canada Nickel, again, some nice higher grade results at Reid. Again, we're very excited about that. That could be bigger than Crawford in terms of the scale up there. And then another bulk tonnage discovery at Sothman. The Murchison Minerals, interesting. I would encourage you to take a look at it again if you're looking for new stories. I didn't have the time to figure out whether they had actually just sandwiched a hole between two historic holes and got good grades, just like they got good on the other intersections, and or whether they had really stepped out a little bit from that prior drilling to get there. And they've confirmed some other targets. But again, you're getting some good 1% to 2% nickel intervals over decent lengths. So, there's something going on. And, they said they've identified some other regional targets. So that's one that I would encourage people to do some work on. Our neighbors, EV Metals, it's good to see. They've got a bulk tonnage target near us, and again, they're getting some decent widths and the 0.25% nickel grade, that you're looking for. The other one that's been interesting to follow is Palladium One. Getting more high grade intervals at Tycho. The key thing here for them is the next step is to start to be able to demonstrate some of those grades over some amount of continuity, depth or width wise, because they won't need a lot of tons at those grades. And again, it's good to see a brand new discovery come to market. The other one, Poseidon, that we've talked a bunch about in Australia. They've delivered their Black Swan bankable feasibility study. So that's the lower grade open pit plus the high grade. There's another animal that's a new high grade deposit, and there's some remnant high grade that was there. So again, good to see some additional nickel supply come to market on that front. And then the other one you'll see, and again, I think worth taking a look at, is Archer has taken all the nickel assets out of Walbridge. Walbridge was a nickel explorer, then made a massive gold discovery, and so they've spun out their nickel assets into a new group. And Grisette is a good, decent nickel discovery that was made about 10 years ago, and then they've got some other properties, in and around the Sudbury area. So those are all pretty good. Good to see some news flow coming, from a range of deposits going forward.
Yeah, I'm excited to see what happens with the Archer exploration stuff. I met the CEO last week, and some of the people who are involved with putting that thing together. And let's see what they do with it. Also, Go Metals. Any news there?
Yeah, so this is one. Again, some interesting. Again, you don't find a lot of nickel at surface these days. That's north of a certain grade, and they got some pretty interesting pickups in a previously unexplored nickel area. The guy who's our VPX actually flew the geophysics for them 3 or 4 years ago, prior to us really getting started at Canada Nickel. And yeah, they had some good targets. They hit some drills. They put out some very splashy pictures of core. But bizarrely, they put this news release out yesterday that was some intervals from some of the not best holes that didn't come from the splashy core. So, they weren't. The fact that the stock fell by half yesterday should tell you that they were not quite what the market was expecting. But we're still waiting for these other holes. So I don't know. Again, keep it on your radar screen. It's definitely one to watch because it's a new area and there's something going on, but we'll need to see what happens with those other holes. The danger with nickel is that you end up with, again, our deposits, the big bulk tonnage ones, when you have the hazelwoodite, aurorite, and it's relatively low grade, we've gotten pretty good at being able to call the grade from what we see in the core, because anything that's sparkly sulfide is generally nickel. When you get into these other deposits where you get more sulfur happening, you don't know whether that sulfur actually has a lot of nickel. There's a mineral called pyrrhotite, whether there's a lot of nickel in that pyrrhotite or not. So the visual clues become tougher to see. And so those assays from those holes with the splashy sulfides in the core, we'll know at that point, how those run. So it'll again be interesting to see on that front. But again, and one just to keep an eye on, given what the valuations are in the market today.
Well, there you go. There's quite a romp. There's a lot of company news there. There's a lot of companies we haven't mentioned as well. We've seen a few over the past 2 weeks as well. Well, jumping on the bandwagon, they've got a lot of work to do, a lot to prove, and I'd say generally, the mood is kind of uncertain at the moment. I think for people who are able to access capital or have access capital at the right times during the course of the year, happy bunnies. Cash constrained companies, not necessarily happy because they're out of control or they're not quite sure what next year holds for them. And maybe it is a case of hunker down, which then comes back to this big, massive problem for commodities like nickel going forward. The next 10 years, super tough for these OEMs, battery manufacturers, to get the materials that they need if the exploration market isn't being fed cash to do the work that they're going to need to do to try and make a discovery. Making a discovery is super hard. It's no given. Most people go through their careers not making one. And then, to allow them to become development companies, which in itself is super hard to get that point of working out the economics of this thing, irrespective of what the price is doing at any one moment in time. It's a tough environment out there. So I'm not. There's a lot of heads down at the moment. What's it cool for next year?
Oh no, I mean that I have honestly. So the only 2 times that I've seen a sort of a greater disconnect between sort of valuations in the mining equity space and the underlying fundamentals of the market were, again, in 2002 with China, 2002-3, people just, again, everyone now claims that they understood China, but again, tell you it was maybe a quarter of the market really understood what was going on in China, and so. You had prices ripping. You had, again, it was clear that we were not going to produce anywhere near enough of various materials. And we saw in the subsequent 24 to 36 months from there, a whole pile of materials set new all-time price highs. And again, I can tell you that there was not one sell-side commodity analyst who was calling for all-time highs for copper, all-time highs for zinc, all-time high for nickel. That was not going on. And that's what transpired in the next 24 to 36 months. 2016, when I was at RNC and we bought Beta Hunt and a chunk of the Reid mine from Hud Bay, we did that with a 20 million market cap because the market was absolutely no bid and we had a little bit of cash and a little bit of market cap. And we were able to trade up the curve. Again, it wasn't because there's this big new shift of something coming on. It was just that the value disconnect that's there was just so massive. And again, right now, to me, again, I think part of what may have driven the, sort of the rest of the auto industry to really wake up to the raw material challenge is I think Benchmark Minerals did a great piece where they converted numbers into this is how many mines we need, to build by 2035, and for nickel, they had, 70 to 80 Crawford size mines. And they went through that for the rest of the materials, and so I think that may have finally gotten through to these guys that you need a lot of mines, and even 2035 is 13 years from now. 2030 is 8. Like if you are not at a PEA or better stage now, you are not going to be in production in most parts of the world by 2030. That's the reality of permitting and engineering timelines. And so, it's horrible to own equities when if you're owning them last January and if you bought your biggest purchase of your own company stock, at that time in January, and everything's off 60%, but the fundamentals have improved so much over the last 12 months, and so I think what's going to kick it off is 2023. Particularly for nickel, is EV demand in the first half. And as I said, last year, they had overstocked and it was going to be pretty sloppy. You're going to see 100% demand growth from the EV sector in the first 6 months of the year. And so people will then go, oh man, what? It's not 30, it's 100. Oh, what happens if that happens again? Oh, shoot. Even if we get all this supply growth from Indonesia, we're we're not going to have
underwater.
nearly enough nickel. Yeah. So it's hang in there. This is one of those times in the markets where you need to have conviction, on your calls. And if you do, it's, 2002 to 2005, you made a boatload of money. The giant herd, the rest of the herd came, and you made even more money in the next, 12 to 24 months after that. It's, this is where we are on most of the battery metals except lithium.
It's scary. It kind of feels like there's a massive supply demand gap now. I'm kind of worried what that means beyond 2030 personally, because it needs to happen now. These are the moments you're setting up now. You're funding it now. You're making it happen now for it to happen in 10 years' time. I kind of feel like some CEOs are banging their head against a brick wall and saying, right, could not just shareholders, please, but could politicians, please, could provincial, state, federal, whatever, could you please understand the time frame here of the stuff that you're promising that we are going to do? You're making it really hard for us to do. That you'll be retired, long gone before these things actually happen if you don't sort this out now. So it's a massive disconnect, not just in terms of equity prices now and what the market should be doing in these circumstances, but also in terms of the way industry is gearing up. It's like they're putting this huge infrastructure in place, hundreds of billions of dollars, and they're not going to be able to feed it. It's it's kind of frightening. Therein lies the opportunity. Therein lies the opportunity, right?
Yep. Benchmark Minerals. I mean, again, they map out the supply chain in detail, and their forecasts are 100% raw material constrained, right? That's their and that's the part too is the demand is there. The demand won't go away. If it doesn't get met this year, it'll get met the year after, or the year after, the year after, right? So again, that's the part that people kind of miss the boat on, is if even the supply chain constraints, you need to roll over whatever kind of demand you're expecting this year. You need to roll that forward to the following year. So
and I think the interesting thing to note here is this isn't COVID driven. This is not war in Ukraine driven. This is a long running and long forecasted, fundamentals story of us moving to a net zero or carbon neutral, or however you want to frame it, environment. And to do that, to build that, to deliver that, you've got a lot of things need to do joined up thinking and happen at the right time. And I think commodities constrained is going to be a big phrase, I suspect, the next 5 years.
Yeah.
But there we go. Let's try and make some money, though. Let's try and make some money along the way. Well, look, the sun is out. I feel like I've got a halo effect going on here. It's like, bye, nickel. So I will see you. You're at a conference, aren't you? What are you doing? Yeah,
I'm at the Deutsche Bank Lithium and Battery Supply Chain Conference in New York. So it's mostly lithium companies, but it was good to get an invite to participate in some of the meetings. So.
And what's the big rallying cry there? Is it we're commodity constrained, or is it right? What are people there to do?
It starts today, so I'll find out. I'll let you know.
Okay. Yeah. Well, best of luck. See you next week.
All right. Thanks, sir.
Have a great one. Thanks for your time today. Cheers.